Welcome everyone to the Aggregators and Brands show. And today my name is Hai. I'm the CEO and co-founder of Eva.Guru, and together with Omar, who is the CEO and founder of Margin Business.
Hey, how you doing?
And we have a great guest, Christian, and from Nextoria, and he will tell us more about himself and what Nextoria is doing. And I think we will have an amazing conversation about aggregators, brands, merch, acquisitions, and all that stuff. So, Christian, welcome to the show.
Thanks, Hi. Thanks, Omar. Pleasure to be here.
Absolutely. Please tell us more about yourself, about Nextoria, and we can take it from there.
Sure. Nextoria is a M&A advisory firm. We're actually fairly rare in that we are venture backed. So we're fully funded. We're fairly new in the marketplace. We're a little over a year old. And what our model is, it's somewhat differentiated because we're like fully funded. Our team, we don't charge any fees up front. We kind of position ourselves to work longer term with clients. So, 12 to 18 months on a full, soup to nuts exit plan, and really drill down deep into the clients that we work with. We're fairly picky in making sure that it's the right fit. I joined Nextoria a little under a year ago. I came from the legal world, actually. So I'm an attorney by trade. I'm a former regulator in the state of Florida in the cannabis industry. I jumped into the private sector. I started a law firm, and that law firm kind of migrated from really specifically regulatory law dealing with governments to more and more dealing with M&A, because that's the way the cannabis market kind of went in the mid to late teens of 2000. And so now I switched over to e-commerce M&A with Nextoria. I love the team. I go back with a few of its founding members, and when you go from kind of very corporate M&A where you're working with these big public companies to being able to work with kind of smaller founders and people who are very day-to-day passionate and in their companies, it's night and day, and it's just a wonderful lifestyle compared to the more corporate M&A lifestyle.
Isn't it? That's what I also think about, and so that's super interesting, the whole acquisition market, because what happened, and one of the reasons why we started this show is we call it the aggregators and brands, but it's pretty much about like the brands and the acquirers, and it might not be aggregators. Obviously, there might be other type of acquirers too. Mm-hmm. Even we see more brands acquiring brands as well. But one of the reasons we started is because like a couple of years back, the whole aggregators, kind of gig started with Thrasio. It's actually started even before Thrasio, but Thrasio was able to grow fast, and then it created all this, ecosystem of aggregators, which kind of, I think there's around 100 aggregators. They acquired hundreds of brands in the last couple of years. And then suddenly, after this Wall Street clash in summer period, and then we have seen the fundings kind of went down with the aggregators. Today, we still see some of the aggregators that are raising funds, but compared to last year, I think it's like 10% of what happened like last year at the same time. So first of all, so how do you see that market? The aggregators market. They were acquiring a lot of businesses. Do they continue from your perspective? Are you working with any of them, or how do you see that acquisition market changing today?
We are working with them in the sense that we have a buyer network of over 1,000 buyers, and that runs the gamut from aggregators to market specific strategics to private equity funds, family offices. So aggregators are definitely a very strong group. I think they should be given a lot of credit for creating the market that existed and flourished up until, as you mentioned, we had a bit of a downturn. The biggest issue with the aggregators and their acquisitions, I think unequivocally have slowed significantly. It's a large part of it's cost of capital. Like, in order to make these acquisitions when debt is extremely expensive, money is extremely expensive, and you just overall have a kind of a contraction of people who are willing to put money up and help with that deal flow. It's tough if you're an aggregator and you want to kind of continue this acquisition binge at a very high rate. I think also some of the aggregators ran into kind of headfirst into a brick wall of reality, as far as like the reality is once you buy these companies, they still need to make money for you, right? So if you're paying outlandish multiples for an underlying company that can't support those multiples, it's not going to be a good deal, and either your board or your investors, depending on who you're answering to, aren't going to be particularly happy. And so part of it is, macro, some of it is micro. And so to your point, we've seen a lot of the deal flow right now has been picked up by strategics. So like, we see in the baby space is very big still. Supplements is still very hot. And so we are also entrepreneurial, even though, we're M&A advisors, but we're constantly trying to look for people who are active and who want to buy the clients that we work with. And so part of that is kind of expanding our own paradigm as to who we're shopping these deals to.
Okay, that's already really interesting. I mean, to go into this world from your perspective as an M&A firm. Hi, do you still remember? Because last week or a few weeks ago, we spoke about the first aggregator, actually, because it was an Indian company. I didn't find the name, but you remember what we were saying, or the guy we have been interviewing. There was somebody down the line who actually did all of this before all the companies like Thrasio and everyone gain so much media appearance. I don't remember it, but I just wanted to bring it out here, because I'm coming to this because when we look at it in 2020, we have been looking at 1 billion in funding. I mean, if we look at it from a real money perspective, 1 billion is quite a lot of money, So this is already wow. And we talk about COVID times. That means some of the funds came out from nowhere and have been deployed in order to buy Amazon businesses. So again, within COVID time, where everyone was like, even the banks were like literally hanging on their money in order to not to lose it or to see what is going on, there were some very advanced people in there who are actually given already the funds out, and we talk about 1 billion. So 2021, we talk about 12 billion. This is the number Hai is always giving. I love it because it sounds so good, and this really shows that the market is was very mature at this point. And afterwards, we talk about 2 billion in 2022. So right now, which is wow, 10 billion less. This trend is a bit worrying, I would say, but at the same time understandable, because what I think, or what we were always talking about, me and Hai, is that okay, the funds are good, it's fine that that they're working with it, but now we need to handle it down and build teams and build processes and build, and like you already said, Christian, that the companies or the aggregators need as well to run these companies successfully, and obviously the ROI needs to be at some point in. So what do you think about this trend? What I just explained, or what do you think? Where are we going to go? And are the companies right now, because they're obviously, we know out there are companies who turning around 1 billion per year, who are turning around 600 million per year. These are numbers which are completely delusional, actually, but they exist. And these size of Amazon sellers exist, and they are growing rapidly in numbers. So from my perspective, I just see an uptrend. But what do you think from an M&A perspective? Maybe I'm a little bit delusional on that point,
Well, let me touch on the simpler part first, which is like what I think that the future will be, right? And so there's a difference between the future of like 2024 and the future of like 2030, right? So I think that like I'm sure every single person who's watching, or the vast majority of your own audience and the people you work with, they're true believers in e-commerce because they should. Like we are living at a pivot point in human history where, you know, for basically our entire existence since we invented currency, we've had a certain model of exchange, and we've created a new model of exchange through e-commerce. And so, and it's growing. So I think as far as inevitably, there's going to be growth. It's going to continue to grow as far as its usefulness, its utility, the proportion of medium exchange in society at large around the world. E-commerce is going to continue to grow. So I think it's a great place to be. It's a great place to invest your time and invest your money. Now, the next year, I think part of what you're describing, the best way, this best single variable I can say as to what's causing that is uncertainty. You know, with Europe, you're with energy. US, we have our own issues. There's a lot of political uncertainty with our midterm elections. We're not sure what direction we're going to go with some basic fundamental economic and taxation decisions in the US. And so it's really hard to make big purchases when you have economic scarcity as far as your ability to deploy capital, when you really don't know what the macroeconomic environment is going to be in the next 6 months. And so when we talk to aggregators, actually, it's really, the conversation doesn't go like, hey, Christian, I'm really sorry to break it to you, but like, we can't do deals. Like, we're insulted. It's more like, look, things are kind of messy right now. If you have a really great company, we'll definitely talk to them, but we're pretty much going to do a pause for like the next quarter or the next 2 quarters. Like, bring something to us in the spring. Like, it's more, and we understand that for these aggregators, it's a little bit more kind of a strategic, like, it's not that we don't want to do deals. It's just crazy out there. It's very difficult to predict how things are going to flow. So before we deploy $20 million for this acquisition, like, we kind of need to know how things are going to go for the next couple months.
Sure. Thank you for that reply. I wanted to put in as well, because we mainly talk about the European economy, or the European marketplaces, and the American in general. Obviously, there is South America, there is Canada, there is a lot more countries, but just in general, because for the moment, if you look at the European Union, there is as well have been many marketplaces added in the last few years. And recently, like a few days ago, Belgium was as well there. That shows for me as well that economically, Europe e-commerce won't go anywhere. They will just grow rapidly, and every single marketplace in these different countries which is going to open, we have I think 27 or 28 if I'm not mistaken. If then half of them going to add a marketplace, that means we create in every single country an own e-commerce ecosystem, which obviously will lead to a rapid growth, and a lot of sellers can make a lot of money in there. So we have now the position of the European Union, which obviously is growth. We have the US, which is, I don't know, there is growth as well, but a bit stagnant, I would say, because where should the growth go if we cannot like geo target within the country, for example, through the marketplace, because it's one big marketplace and there is Walmart and there is some others. But my point now is where I want to go is, for example, the UAE and Saudi Arabia. What we see is that a lot of companies are going there, and even governments are going there to search for funding, for example. Do you or Hai, do you have the same information, or Christian as well, what I just mentioned?
Hai, do you want to take that? Or do you want me to?
So I'm going to just kind of start from what Christian said, and I like to always talk about data, right? Because I'm like obsessed with all.
You're the data guy, exactly.
You know, getting from Amazon sellers. I mean, one of the things, like when people talk about e-commerce, this kind of like shows a little bit like, the way the e-commerce penetration versus retail. And the only trend that we see is it's going to be up. Like it's never going down. So we are expecting that like people are going to buy more and more products from e-commerce rather than retail. And US penetration today is maybe around, during the COVID times, it was, kind of hit to maybe even 30%, where originally before the COVID, it was around 17%. And now we see that it's, kind of growing from 22, 23, 24%, but it's only going up. So that's, I think, the first thing to mention. Why I like this trend, why I like this graphic, because it also shows that people are buying more supplements from e-commerce. People buy already the CPG products. And if you think about it, 2 years ago, like nobody was buying grocery or items from Amazon. But today, now there is no COVID, at least not in San Diego. I can tell you that. Nobody remembers that anymore, what the mask was or things like that. But people still continue to buy CPG products, supplements, and all types of things they were buying, continue to buy from Amazon or other type of e-commerce channels. Another thing that just happened on September the 7th, right? Like where, we talk about like the Clash and all that stuff, but one of the Amazon native brands, Hero Cosmetic, sold for 630 million. And
exactly,
we talk about like multipliers going down, right? Like 3%, the 3x, 4x, which is right. But I always kind of tell to my, sometimes, we go into the dilution of mediocrity. What I mean to say is like, maybe there is an average, like 3x, 4x, maybe there is an average, but who is average? Like, which brand? Like, if you think that your brand is just an average brand, what's the point? Like first of all, you need to create a brand which is really great, right? Like, the founder, and if I'm thinking, hey, my brand is average, okay, then get your 4x and go. But if you are building a brand like Hero Cosmetic, and you can see that on this graph where
beautiful
multi-patch sales, like in terms of ranking, it went from 300, like this is the bestseller ranking on Amazon that we very much like monitor, and this brand pretty much like dominated the #1 point. That's the best brand, right? I'm not saying we can talk about the #1 guy, but it looks like if you are a brand and if you are in the top 10%, if you are dominating, then this guy got 14x multiple. I'm not saying everybody will do that, but what I'm saying is, if you're innovating the product, if you're in the top 5%, if you have a great product, hey, people, somebody will buy. If you want to sell, for sure, you're going to get a great market. So why to deal with this average multiplier? Everybody has a different reason to exit, but building the great brand is important. Now, back to what Christian said, you said you work with the brands like in a long term, not just like, hey, you want to sell? Okay, I'm the broker, I sell it in the next 1 month. I don't know. It looks like you have a different approach to this. So maybe you can tell us that too, like, because it's very interesting to me why you are thinking of long term. Isn't it just one single transaction? At the end you buy and go. So looks like you kind of understand the value here. And sorry, like Omar, I kind of like jump into the back to the thing. And then obviously there is European and Saudi and funds, that might also back up the venture capitalists and all that stuff. But what's your feeling about this long-term strategy?
Okay, so I'll do the Saudi thing, and then I'll switch over to the high question. So on the Saudi thing, I think that kind of it is almost obvious. Like when you have these funds that are ultimately I don't want to say 100% of the capital, but like disproportionately funded by the fossil fuel industry. I mean, not a lot of industries are doing great worldwide right now. That one is doing pretty well. So when you have, I'd say you have relative economic issues in Europe and frankly right now in the United States with fuel prices. When you have a region of the world that's really benefiting from those economically, it's a nice place to go for investment capital if you're seeking. Now we don't really, candidly, I don't deal in my day-to-day work with venture funds or with financiers out of the Middle East much at all. So I would be disingenuous if I said I had a lot of firsthand knowledge, but I've heard the same things. What you've said doesn't, it rings true to me. And to your point, like, because we're a bit newer, and because we really like the touch point of working with founders, really, I would love if Nextoria was handling like a $400 million deal. Great. We can all fill our garages with sports cars. That'd be great. But I mean, like, certainly we would. I'd be very excited to work with a company like that. I think Nextoria could represent them amazingly well, and we get them a great deal, maybe even a better deal. Our target client that we tend to work with are $5 to $20 million deals, and those enormous, amazing multiples that you just pointed out, they're possible, but really it's kind of a sliding scale. As you get higher revenues, as you have good margins, as you kind of package these whole things, the multiple go up. And so if you're a diamond as far as a company, you're going to have a demand a higher multiple than if you're a $5 million supplements company with 60 product offerings, and your margins are fine but need work. Your marketing is fine but needs work. What we do is, frequently when we're talking to someone, so say I'm sitting across the table at a conference, and I'm talking to an e-commerce seller, and one of the first things I ask a lot of e-commerce sellers is, what's your plan for exit? When do you have? And most people will respond, like 1 out of 10 people will respond back and it's like, I have this plan, I have my pitch book ready, like my finances are all in order, I'm just waiting for that right time. A lot of people are like, I'd like to do it someday, but they don't really have the plan to do it. And so what we do is we're like, well, let's get into your seller board. Like we'll get on a consultation call. We'll dig into your financials. We'll come back and we'll kind of tell you what our appraisal is and what our recommendation is. And frequently our recommendations, if your finances are a mess, we have to get your finances in order. If your marketing or your OpEx or your supply chain are a mess, we need to get that in order. And what we find at the kind of the lower end of the spectrum, so getting out of like the 40, 50, $60 million deals, if you're dealing with like a $5, $6, $7 million deal, you can really have a strong delta by preparation and getting your company in order and really nailing that first impression with the buyer, so they take you seriously and they feel like you have a very strong, healthy company versus a company that needs a lot of work once they buy that, because that shows up in what they offer you if they feel like they're going to have to change a lot of things and your underlying company isn't particularly healthy. So that's what I would say. It's like our multiples aren't quite what the huge companies for this, but we do improve, and that's why we can justify our fees when we're working with clients, because we'll raise what their ultimate acquisition price is more than it'll cost them to work with us.
Makes a lot of sense. And one of the things that I always see when we start working with a brand which is already successful, like for example, last year, let's say they moved from $1 million to 10 million, which is very much a possibility in the Amazon world. But then when we look at that 10 million revenue, and let's say there is 18% margin, what we did was like, when we start working with them in 3 to 6 months, we see a 30 to 40% profit increase. And it's very normal. Why we are able to see that 30, 40% increase? Because they do not optimize everything. Like when you are growing as a company, and I have the same problem even with Eva. Sometimes internally, people ask me, hey, we don't have this process. Like, why we don't have this process? Hey, because we didn't even have that department like 6 months ago, and that's why we don't have the process. Now, it's very normal for the growing companies, like they do not optimize on ACOS, on advertising costs, on inventory, supply chain, even Amazon audits. Like we do something called reimbursements. And with that reimbursements, we are just able to bring to that company that we thought, we talk about like an additional $65,000 as a profit, and they didn't even know about that. So that kind of like things which helps the operational efficiency as well as revenue growth, that can easily grow the profit, grow the margin. Probably that's kind of like what you're referring to. And obviously people, like the buyers look at the multipliers as a multiplier of the profit as well, right? I mean, if I'm mistaken. So that's even more important today, even with the startup world being a SaaS company. In the last year, the venture capitalists were looking at the growth and month-on-month growth. And this year, what I'm seeing is like, hey, what about your profits? What's your LTV to CAC? And I mean, how much profit you make? I mean, these kind of like questions come first rather than the third place. So I fully understand that as well. So I mean, that's so are you like, how are you helping then? Like, if you see that like the finance is not properly, the bookkeeping was not done right, or I don't know, like maybe there are some other problems with the finances. Do you guys have that department, or you outsource it, or how does it work?
We have strategic partners, so depending on the market that you're in, we have people who we can recommend what to do. But really, we should not poo-poo that initial conversation, which is the loving hand on your shoulder and being like, people in your life haven't told you this, but your financials are terrible. Like, you really need to clean these things up. Like, if you're going to submit these to a buyer, you have to use accrual-based accounting. Like you need books, and you need a bookkeeper, you need an accountant, and one or both of those people need to understand the business of e-commerce, because there's some quixotic things about the company. And it's interesting, to your point, not to pivot too much, but it's fascinating because a lot of the dynamics that e-commerce is experiencing, the American cannabis and Canadian cannabis markets like experienced 3 years ago. So there's actually some very similar dynamics, and it's very interesting because the sentiment you just expressed was the same thing that people were saying in like 2018-19, where it was like the cannabis market exploded, where everyone was chasing revenue, and they're chasing in a US which limited licenses. We're chasing like licenses in specific markets so that they could have market penetration, and they were treating these things like tech companies, valuations like tech companies. These things were all anyone cared about was growth and revenue. And then people figured out none of these companies were making any money, like they weren't profitable, and that completely changed the analysis for M&A, where like people started caring about profits. They started saying, if I buy your company, am I going to make my money back, and how long is it going to take me to have a return on my investment? The exact same thing is happening in e-commerce right now. Very similar dynamics, where the perspective is moving from kind of a sugar high of revenue to like, let's put this on a spreadsheet. Let's do some math here and actually figure out what our ROI is going to be on this business as adults. And I actually think it's fair, like it's painful, but like the aggregate effect of everyone kind of taking the math a little bit more seriously, I think it'll be beneficial for people who run their company like grownups and who have really solid companies to sell. And I think that we're separating some of the wheat from the chaff right now.
Well, that's a very, very nice explanation of everything what is going on at the moment. And in order to wrap this up, as well a little bit if Hai still wants to ask something. I just want to make sure that we have everything in one go. How would you say, for example, makes you difference, because you're an M&A firm, and every M&A firm have a little bit of a specialty and a little bit, you know, some help clients directly, others just throw the money, get the company, and that's about it, or they follow through on the whole process, and like you said, you work with the founders or even the buyers all together, keeping it in one go and making sure that everything goes smoothly. What would be your reply on this? How you would set apart you as an M&A firm in order to choose you to work with you?
Sure. So first and foremost, we're very high touch on clients. So like we are not just kind of let's just get your pro formas, get your financials, get your slide deck, and just flip you. We work very intensely. I mean, if they want to just flip, they say we need to sell this company in 30 days, make it happen. Like we can do that. But our focus is really working with people who might need a little bit of assistance and getting them to where they need to go. Our fee structure also is for entrepreneurs who are kind of still building. They're putting everything they can back into their company. You don't owe us a single cent until we ultimately sell your company. So our fee structure and our touch point are kind of very key differentiators. I would also say, like, once you start working with us, is we are very, very good. Like, we have ex-Bain consultants, we have people within our organizations who have built and sold their own companies before. We are very good at getting in and helping kind of diagnose issues, at helping you put your best foot forward to buyers, and also, you know, visualizing your data. So we have a lot of we have a very high competency and a high degree of sophistication in our ability to take what you are doing and translate that to precisely kind of what buyers want to see as far as visualization. So those are our primary selling points when we talk to clients. We also, I know this doesn't show necessarily up on a slide deck, but it's a fairly young company. Everybody there really likes e-commerce, and they really like working very closely with founders who are passionate about their business. And so it's generally a very positive interaction in dealing with us. We're on your team very strongly, and we get very emotionally connected and wrapped up in making our founders and our sellers successful. So we lose sleep with you. We get very, very happy when you sell as well. So that's kind of our key points of differentiation.
Amazing. Thank you.
My pleasure.
Thank you very much. You know, that's really a great conversation. I think we went through a couple of things that are very important for our audience, both in Europe and in the US. Hundreds of brands are watching this. So thank you, Christian, for the time.
Thank you so much, really.
Absolutely.
My pleasure. Thanks, Omar. Thanks, Hai. It was wonderful to talk to you guys.
Thank you. Bye.
Thank you. Likewise.